Welcome back to Echo Trade. Today we've got Jim Vassas from Cairn Investor Services jumping onto the platform. His portfolio has been killing it in his own account and for his clients for the last year and then plus. So we've been talking for a while about working together and excited to have him on the platform. Jim, good to have you, man.
Thanks for having me.
So we're going to talk about Jim's going to offer his Cairn disciplined blend portfolio on Echo. We want to dive into that, kind of learn more about the history, kind of what you're trying to do within the portfolio. So I'll hand it over to you, Jim. Give us kind of the overview of the portfolio. What are the goals? Kind of how's it different? What's your philosophy?
So I think in general, when you want to talk about portfolio construction, I think the ultimate impact that my decisions are having on the investment or in the client's portfolio, the return, how we carry that out through retirement and all the other goals that we might talk about. I think for me, it's important that portfolio management, life in general, right, is about decisions. Those decisions are ultimately determining the outcome of my portfolio, right? And so if my goal is to help everybody achieve what we would call financial success, and we work on that individually, I got to be very careful with the decisions I'm making. And so I think at its core, at its foundation, I have a certain set of principles about how I view money, how I view the financial planning process, how really this holistic approach, understanding the financial plan and then making investment decisions in unison with that plan affects, that outcome. And so I think the first thing, as silly as this is before I worry about making money for the client, I need to have a plan to avoid losing it. And so I think at its core, this portfolio and the investment decisions that I make are really catered towards loss. And so before I worry about, what's the potential for this security to make? How great is this new battery going to be on the market? How great is this new software going to be? Technology going to be? Whatever. I'm really worried about what could really go wrong. What's the downside risk or potential involved in here? I think we'd all agree, and there's plenty of studies on this. When markets are going really well, you could throw a dart at a dartboard, pick a stock, and you're probably in okay shape. And I think that's something that we've seen certainly in this last bull market. But as the volatility starts to enter the market, as uncertainty starts to enter the market, if you have a foundation that says, hey, like I am worried about loss first, that changes the mentality. And it changes the effect of the decisions you made. I think right behind that then is putting a clear defined objective on what I have for that stock, setting an expectation for that stock. And I'll say realistic expectation, right? And so that really comes through a blend of different types of analysis, like using technical analysis, using fundamental analysis, maybe a psychological approach to it. And really trying not to favor one part of that analysis over another, but giving them equal weighting. And then once you can do that, and you can do that objectively, I have a realistic expectation of where I think the stock can go. I know what I would expect to lose or what I'm comfortable losing, but now I know where that objective for that stock is, I'll say, clearly defined.
Yeah, I mean, it reminds me of, with traders in general, kind of more shorter term guys, they're very concerned about, you see these ads pop up for, 95% win rate. And, they're very concerned about, kind of, how often they're winning versus losing and profitable versus not. But the reality is, it's a Soros quote and, whatever it's politics. I don't care, how often you win or lose. It's how much do you make when you win and how much do you lose when you lose? Because if you have a 98% win rate, but you win $1, you make $1 on every win and you lose 100 on the two you don't, you're deep in the red. So talk about that. Then you said, risk is obviously something that's very key in terms of, your initial process and your first and foremost. So how are you looking at risk? How are you kind of managing that and mitigating that?
So that would tie into probably the last point of my thought on this would be risk is something you can control, right?
Yeah.
I can't control returns, but I can control risk. Okay. And so I will control risk multiple ways, but first and foremost, would be having an appropriate, something simple like having an appropriate stop on a security. Okay. And so I don't want to be walking in, like I said, to a purchase, an investment decision, and not saying, hey, I'm only willing to lose this much money on this company. And so that the initial answer to your question is we will have a stop in there. What I think is important right behind that is, well, how is some of this stuff determined? And so one of the things that was taught to me, unfortunately, later in my career, so this is, I'll say, more recent understanding of investments relative to like 24 years ago when I started or so, is once you make a decision to buy something, it has to be a business decision. Okay. It is there's no emotion into this trade. Right. And I think a great way to control risk, like with that stop, is saying, I'm not going to be emotional on that decision. And so if that stop gets hit, that stop gets hit. I'm not going to adjust it. I'm not going to buy it back. I'm not going to I'm not going to double down on a bad decision. Right. Those start to be emotional changes. And I actually have guidelines. Like I physically put into place, how much am I allowed to lose on a particular company? And that is relative to the size of the investment, the I'll say risk class, right? Like maybe a small cap company versus a large cap company. I'm going to allow for different movements in the value of that company. But there's still a bottom, right? So let's, as an example, let's say it's a large cap company. I might have 3 stops in. If I expect the company to go up and I'm buying it with the intention that it makes money, certainly don't want to lose. Now you got to manage that decision in the moment to, the economic condition, the volatility of the market, and understand that there is volatility. I won't be able to avoid volatility 100%. So in that mindset, I'm going to say, hey, you know what? Maybe I'm out at certain percentages. So this stock gets, let's say, 8% window to operate in. It's allowed to drop 8% before I would worry. That should be some normal course of movement for this stock, where I shouldn't be worried as an investor, as an advisor, that I would have to worry about some emotion entering into my decision.
Yeah.
Okay. Now I hit that 8%. Well, what happens? All right. The benefit of me managing somebody else's money, I could be less emotional with it, right? That's probably at the end of the day one of the biggest benefits of working with an advisor, because I'm emotional with my money, and I have to talk to other advisors sometimes because money's very personal. Okay.
Yep.
But at 8%, and I hit that stop, the business decision kicks in, and we say, okay, let's reduce our holding. We're outside of what I consider normal. Is it temporary, or is it the start of a longer new trend? And this stock is not going to stop at 8%, but it's going to keep going down 10, 12, 15, 20, 30, whatever that looks like. And so the first part of that managed loss conversation is, when we are initially outside of our expectation, we're reducing a certain percentage of that hold. So let's say 30%. So make this easy for conversation. We'll do 3 trades. We'll be at 33%. So we move 8.1%, trade goes off. We've reduced the position by a third. Okay. How much more can it go down? So let's say our next target would be 10%. At 10%, the next third would go down, would be sold. All right. And finally, let's say at 12%, because that's really where we considered anything I could think of. There's just no reason I can fathom why this stock would be down more than 12%. There's got to be something else going on. We're out of the position. Right.
Yeah.
And so you're taking this risk, you're quantifying it, and you're putting in rules to protect yourself and your client from loss.
Yeah, that took the words out of my mouth. I was going to say, you're quantifying that risk and simplifying it from a management perspective and from a client perspective, or somebody kind of utilizing the portfolio through Echo Trade. You kind of have a more defined understanding of where your risk lies versus, if you're kind of looking at things on a more subjective and potentially emotional way, then there's really no bottom. It's, well, let's just kind of see where this plays out. So I think that could be attractive for people.
Yeah, yep. You find doubling down on a 20%, change in value looks like a good decision, and all of a sudden it drops another 20%. So, yeah, for sure, really,
Exactly.
really can keep you out of harm's way. But you have to now. Now we talk about loss, but the other half of this is what happens when the security goes up, right? And I think anybody who's been in my industry long enough or working with advisors probably heard the uh, hogs get slaughtered, pigs get fat,
Mm-hmm.
right? And so
Mm-hmm.
there's an expectation for the upside too, right? I shouldn't be buying, let's say, a blue chip company that goes up like 500%. Like that just might be a little crazy to see a big blue chip company shoot up and act like a small cap company on paper. Like that probably is not a
Yeah.
realistic scenario. Okay. And so
Mm-hmm.
just as we have habits for the downside, we also have that same approach on the upside where we are forcing ourselves
Mm-hmm.
to lock in profit. Because at the end of the day, if you don't sell, you didn't make any money.
Yep. Well, let's talk about now. Tell me. Sorry to interrupt. And I just want to kind of nuts and bolts now. Kind of switch the direction. What exactly are we investing in? Are there ETFs or all individual names? All U.S. based? Are you kind of all cap, like you're talking about large cap versus small cap? What's kind of the focus areas for you? Or are you just, hey, let's let the market kind of dictate? Let's let the wider universe of names be available to us, and let's see kind of what the market, where the opportunities are lying.
So I'm going to go on the tail end of that is my answer. I'm going to look at the market. I'm not going to force my theology or my decision into a growth conversation, a value conversation, a certain size company, maybe either a certain asset class or even a certain type of investment. All right. So
Yeah.
first and foremost, I really want access to everything because I want to be where the opportunity is. That's it.
Mm-hmm.
Right.
Yeah.
So like I want to remove the emotional decision of loss and doubling down on a bad decision. I don't want to have bias enter into my head and say, Josh, I've lost money on gold, so I'm never going to invest in gold. And oh, by the way, you know what? Maybe all commodities are bad, so let's just cross them off the list too.
Yeah. Mm-hmm.
So it's important to remove bias, and we build that up over time through bad experience and bad relationships and bad decisions. And so I want to say I like the whole marketplace being available to me. Number one. Number two, in preference, and I think this is something maybe misunderstood in the investment community. I like buying individual companies. And I, constantly get feedback of exposure and risk and this and that, and everybody knows this mutual fund is better because it's diversified and blah 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 blah. It is so cheap right now to buy and sell stocks that I can almost go out and create any mutual fund you find in the market cheaper than what you're paying to buy it for.
Yeah.
And so because of that, I like being able to buy 30 or 40 companies.
Mm-hmm.
And what's the cost of ownership once I buy a stock? Zero. Sits in your portfolio until we sell it. It costs you nothing. What's the cost of ownership in an ETF? Whatever that management fee is.
Yep.
Right? So
yep, absolutely.
If you have a buy and hold mentality, that's fine. That's great. It's successful, and I can get behind that. We can talk about tax avoidance and a whole bunch of other things that could provide for you. But then the best way to do that would be, own the securities, go out and buy 30 or 40 stocks that you like, find a portfolio manager, look at what he's doing and say, hey, these are really good holdings. And if I just go buy them, I don't have to pay a whole portfolio manager to hold them for me. So I do like, because of that, I like the individual stock community. If we look at ETFs, it's usually one of two ways. It could be broad exposure. Like, I'm not going to go out and buy the S&P 500, right? Like, I'm not crazy. As much as I like individual stocks, I'm not crazy. So if I just broad exposure to a market, I'll look at a very low cost ETF. Like, let's just say SPY as an example, right?
Yep.
Super low cost, S&P 500, and my clients have just market exposure in general. That and there's reasons why we do that or don't do that, but that's a great way to get quick diversification at a very cheap price and get the exposure you need to, in this case, the S&P 500. So when I incorporate ETFs, it's because I want exposure to that asset class or that group, not because I really spent the time going to research individual security, right? Because there's a trade-off to making a decision. There's a lot of work involved in that. And otherwise, there's some really great ETFs out there, companies who have a really good methodology or screening process that I honestly don't have time for, right? Like they're like cash flows and all these things and debt, and like they're going to only invest in this tiny window, and that ETF might make up 30 or 40 of some really good, solidly run companies. Well, I can kind of take 30 or 40 companies and bundle them together in this example as an ETF. If I don't buy an ETF for general broad exposure, I'm buying it because there's some specific holdings in there that I want. And so instead of me going out and trying to buy those 15, 20, 30 companies for my client, this ETF has like 90% of what I want right now.
Yeah, that's incredible. I mean, maybe to cap it off, what would you say kind of just, short, long-term goals for the portfolio? Are you looking, kind of at shorter time frames? Or are you really just saying, hey, listen, this is something that through market cycles is where your kind of long-term focus is? Or are you saying, hey, let's look on an annual basis, let's try to do our best, year in, year out, while also kind of being able to outperform over the long run?
Loaded question. I'm just saying, yes, all of it. Like you have to be tax efficient, right? So, so certainly we are looking at the short-term time frame because we're looking at if we want to make an adjustment to the portfolio, add, how's our exposure to certain things or certain stocks, right? Something could really perform really well, and we could be like, wow, this is starting to take up a big percentage of the holdings, right? And the minutia of that, I don't know if I want that much exposure to, I don't know, Microsoft. It's a great company, but I don't know if I want 10% of my clients' money just with Microsoft. So on a short-term basis, I'm managing that, but I'm accounting for taxes and I'm looking at what's going on in the portfolio. So there's a short-term perspective on the portfolio. We look for certain entry points. So if you want to build a position into something, right? Like we do like Microsoft. We're just going to take a position in Microsoft. Then what we're going to do is I'm not going to take all of my clients' money and boom, one day put into Microsoft. I'm going to look on a smaller time frame. So let's just say daily for opportunity in Microsoft. And maybe over the course of 9 months or 18 months, depending on the environment, we will build the position in Microsoft as opportunity presents itself. So I think we're looking at this on a smaller time frame for opportunity, while we want to kind of cater to the long-term success of the portfolio.
Got it. Now that makes perfect sense. We've been talking for a long time, Jim. Like, I'm glad we finally were able to partner up here. I'm excited to have you and the portfolio on the platform, and excited to see what the future holds, and be able to give more investors access to the expertise of Jim. So appreciate it. I'm glad to have you on the platform. Thanks for the time, Jim.
Thanks for having me. I appreciate it too.